The Fed cuts by a supersized 50 basis points and signals a total of 200 basis points of cuts by the end of 2025. Indonesia also cuts rates. And in Australia today, the RBA will be watching jobs figures closely, while in New Zealand, June quarter GDP is expected to show a drop in output. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview from the recent ANZ-sponsored AFR Asia Summit, ANZ's head of geopolitical risk, Cameron Mitchell, reviews the rise of tariffs as economic security tools and looks ahead to what the US November election will bring.
This goes to the point that there is a wicked policy challenge as countries try and build up economic security, and they don't have the tools that really answer or solve the problem neatly for them.
But first, in 5 and 5 with ANZ, the Federal Open Markets Committee has just cut its benchmark rate by 50 basis points to a target range of 4.75 to 5%. US Treasury yields dropped immediately, while stocks rose. Policymakers said they had gained greater confidence that inflation was moving sustainably towards 2%, and that the risks to achieving the Fed's employment and inflation goals were roughly in balance. Here's ANZ Head of G3 Economics, Brian Martin, shortly after the decision.
I think where it falls is that the Fed are catching up, having not cut interest rates in July. The forecasts they've projected for the end of this year and indeed going into next year show modestly lower inflation and slightly higher unemployment. So they clearly see the risks moving back into greater balance, and I think they want to proceed with moving towards neutrality.
The US dollar tumbled 0.5% after the oversized cut. Shortly after the announcement, the Aussie dollar was trading up 0.78% at 68.08 US cents, while the Kiwi was up 1.1% at 62.55 US cents. Number 2. Ahead of the meeting, markets had been evenly split on whether the Fed would cut by 25 or 50 basis points. The Federal Reserve's dot plot, projecting where rates are likely to head, priced in 100 basis points of cuts this year, implying 2 more 25 basis point cuts by the end of the 2024, and another 100 basis points of cuts across 2025. Here's Brian.
So we're looking for 200 basis points of cuts really over the next 12 months. And then the Fed have another 50 basis points of cuts in 2026. So it does suggest that their expectation for neutrality for Fed funds is somewhere between 2.75 and 3%. Interestingly, growth forecasts unchanged at 2%. So the move of 50 basis points today, I think, is underwriting the soft landing outlook.
Number 3. China delayed its 1-year lending rate decision yesterday until later in the month as it continues to reform its monetary policy toolkit. Meanwhile, Bank Indonesia yesterday cut 25 basis points to 6%. ANZ economist Crystal Tan says the Bank Indonesia has made 2 key shifts in its stance since August.
Firstly, BI now expects the Fed easing cycle to be more aggressive than previously anticipated. Secondly, BI's monetary policy focus is now balanced between stability and growth versus its previous priority on stability. Overall, BI's decision to cut its policy rate signals its comfort with managing global risks. We now anticipate a further 25 basis point cut in the fourth quarter, taking the policy rate to 5.75% by year end.
Number 4. We get data today on the June quarter GDP in New Zealand, and it's expected to contract. The question is, though, by how much? ANZ economist Henry Russell is expecting a 0.1% drop. The Reserve Bank is forecasting a drop of 0.5%. Henry says financial markets are focused on whether a number below the RBNZ's forecast will cause a 50 basis point OCR cut in October.
Based on where our forecast is and where we see the risks, we do think a material downward surprise to the Reserve Bank's forecast is unlikely, but we certainly wouldn't rule it out. But even if Q2 growth does surprise to the downside, the Reserve Bank will need to weigh that against volatility in the data and what that means for momentum moving forward, but also emerging evidence that the economy is already responding to lower interest rates.
Number 5. ANZ senior economist Catherine Birch is expecting Australia's unemployment rate to fall a touch to 4.1% in data out today as the participation rate drops. The market consensus is for unemployment of 4.2%. The data comes a week after the RBA warned it had been surprised that the labour market wasn't weakening as expected.
There were a couple of measures in particular that, as the Assistant Governor mentioned, average hours worked and also the underemployment rate, which she said had not eased as much or had seen limited easing over this year, which came as a bit of a surprise to the RBA. So those measures will also be, I think, in focus when the data come out later today around how much we're seeing from a broad range of indicators around the pace of easing in the labour market, particularly because we can't just put too much weight on unemployment alone.
Catherine Birch there. Now, in our bonus deep dive interview, I spoke with ANZ's head of geopolitical risk, Cameron Mitchell, after the ANZ-sponsored AFR Asia Summit in Melbourne. We talked about the rise in the use of tariffs in economic security policy and what to expect from either a Trump or a Harris administration on continued use of tariffs.
I think the tariffs issue is one of, I guess, not a lack of options for governments, but a lack of a neat policy tool to address the concerns they have around economic security or whatever it may be. So they have a toolkit, which traditionally we saw things like sanctions and so on sitting within that toolkit, which were used against countries that other countries didn't agree with or had taken policy steps or values steps that were inimical with the country that was sanctioning them, right? And of course, they've been used to great effect to deter or to prevent the expansion of weapons of mass destruction and so on. Now we're moving into a bit of a different era where countries are starting to compete with each other economically. You're finding the same tools, but for a different challenge. And tariffs, I think, are just one of the list of the tools available. We've seen also things like outbound investment screening mechanisms to complement the inbound investment screening mechanisms that we're more familiar with. And I think this is all goes to the point that there is a wicked policy challenge as countries try and build up economic security, and they don't have the tools that really answer or solve the problem neatly for them. So we're seeing a combination of tools being used, arguably some in a trial and error phase, others not. So I'm not going to sit here and say that tariffs won't be used as a tool in the next 10 years, but I do feel like we're at the beginning of a process where countries are using tariffs because that's the blunt instrument that they have available to them today. When we start to see what the second and third order impacts of those tariff measures will be over time, potentially we start to see them tempered. One thing that really jumps out to me in terms of tariff use in the last few years has been, certainly in the US example, the use of tariffs against what you would consider to be allies and adversaries alike. Potentially those sorts of things start to shift. Similar to industrial policy, to be honest, where we've seen a lot of industrial policy steps taken, and the industrial policies, much like the tariffs, have been developed in isolation. That potentially causes second and third order impacts to your relationships with your allies and partners. We might start to see some of that evolve over time.
Do you think there's a vast difference between, let's say, a Trump presidency or a Harris presidency in where the tariff trends might go globally?
Yes, definitely, Bernard. And obviously we're doing this chat on the margins of the AFR Asia Summit. Neil Thomas, one of the speakers, gave a really useful sort of summary of the key distinctions between a Harris and a Trump presidency as he saw it. And of course, the big thing he flagged was the use of tariffs. So in the trade space, there's definitely a different approach to tariff use depending on which side of politics you're from in the United States. A Harris presidency, I would argue, much like a Biden presidency, will probably use the tariffs quite sparingly. We've seen tariff measures being used by the Biden administration already against Chinese EVs. That is quite new. So I don't think tariffs would be off the table, but they would be used far more sparingly, as opposed to a Trump presidency in which I think the idea or the concept of tariff employment is almost, it's not ideological, but there's a far more sort of discussed and voiced set of reasons and rationales as to why the Republican Party under Trump want to be using tariffs far more. And of course, if you're looking at cutting taxes in the United States, which is potentially one of the policy measures that the Trump team would be taking, you potentially, as far as they see it, you can gain capital from tariffs. Now, I'm not an economist, but there are sort of a number of free market of economists that have called out the concerns around that approach. But for me, I don't think it will really stop at least efforts in the first 6 or 12 months of a Trump administration where they are going to be rolling out tariffs in fairly large numbers.
ANZ's head of geopolitical risk, Cameron Mitchell there, speaking to me just after the AFR Asia Summit in Melbourne. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, September the 19th. What a doozy. Catch you tomorrow with the Bank of England's rate decision and, of course, the next day analysis on the supersized start to the Fed's easing cycle. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. please view the podcast disclaimer available via your media player or email.